Are double calendars a good play for earnings? I was thinking to test one for Intel earnings. I'll find the discussion that we've had on this before is a more in-depth discussion that I'm going to go into right now. I'm not a fan of the double diagonals, a calendar call and calendar put spread, either using the in the money ones, which I prefer to use because my obligation is covered, rather than the out of the money ones. You get less debit with what's called sort of the out of the money calendar spreads or out of the money double diagonal. But at the same time, the maximum profit is about even. They're parity trades if you think about it. Now, what's the difference? Okay, so we have INTC. The comment was I might want to use this for Intel. Test one for Intel. All right. Now, as we know, a calendar spread is any combination of buying. I'd go at least 60 days out, even if it was an earnings play. You might be thinking I'm just going 1 month and 1 week out, but I'm going to do my standard at least 2 to 3 months out in time here. And if I'm doing a calendar call spread, I typically like to buy an in-the-money call far term and sell. You said next week, right? Oh, you just said for I didn't check the earnings. So let's go out to the 28th, 14 days away. I'm going to sell slightly out of the money. Okay, this is a double diagonal that I'm looking at here that I'm going to use, okay? So, whoops, it added twice. So a standard structure I might use for a diagonal call spread, again, buying the slightly in the money call and doing the at or just out of the money call for selling premium, looks like a skewed covered call position. Okay, now, what would a double diagonal be? Well, I'm going to do the same exact thing, but on the opposite sides. So our stock's essentially at 32. And I went with the 25 call, 7 points in. So let's just call it the 39, just to keep things equidistant and almost about at the same price. 715, 730 for the long, 720 to 735. Now on the flip side of that, we're going to do the same thing again with a short call. We sold the 33 call, yeah, 1 and a little bit away. So let's do let's keep the same premium. We'll do the 31 at 77.79. So this is my calendar put spread, diagonal. Buying a slightly in the money, 39 strike put, 60, 70, 80 days out in time, and selling one near term, similar distance apart. Now, essentially, as you can see, this looks like an iron condor that got bent. It's essentially what it is. We have a max debit of $12.96. That's the most we can, actually, since this is a true diagonal, that's the monetary requirement, excuse me. The most we can lose is only $4.96 on the position if the stock's up really high or down really low. Potential of an 11% return or 10.9% against the cost basis, 141, 10.9% against the cost basis of $12.96 on the position. And yeah, maybe it looks more like a short strangle. Now, I could do something very similar with this with a lower debit by buying the out of the money series. So instead of buying the in the money 25 call and the in the money 39 put, which covers my obligation at 31, just like a debit spread would, right? If I'm assigned at 31, I have the right, and I sold at 31 and I'm obligated to buy shares of Intel at $31, the out of the money put. I can force or exercise this put to force someone to buy it at 39 and get $8 back. And then you can see there's where the risk and the profit is in that case. So now we could just buy a cheaper, keeping the same strike difference here is 8 points and 8 points, excuse me. But we could just flip this and I could pay less by reversing the two, buying an out of the money June 25 put and buying the out of the money 39 call. Am I in June? Wow, those prices looked really cheap. Sorry, but they are. And so let's go ahead and submit that. Almost identical risk reward profile, but this is actually done at a credit of 108.50. However, you're going to have to put, your broker will likely require you to put up the monetary requirement, because this is a bearish calendar. We're at 33 and 39, meaning what? Just our previous discussion. I sold a call at 33, which obligates me to deliver shares of stock at that price that I don't own. I have the right, even if it's 63 days out in time, but I have the right to buy shares of stock at 39. That looks like 37. I apologize. Let's go 33. There we go. At 39. So essentially, this is kind of like a bear call credit spread with an obligation at 33 and the cover at 39, which means I'm going to have to put up the monetary difference of $6 or $600 per contract in this position. I start off with a credit in this case. That's what we mean by the out of the money diagonal, because you're buying out of the money call and out of the money put for a cheaper price. Could be done at a credit, but you still have to put up the margin requirements, so the cost, effective cost, still comes out to be about the same, because you'd have to put up both 600. So the monetary requirement, in my mind, would actually be close to 1,200. But you do take that 108 off for the credit you receive. Max risk, what do we say? It's about the same. Max return looks a little bit higher here because of the credit received, and it's basing it off the risk. But the monetary requirement, in my opinion, would still be 1,200, not 600. Okay. All that being said, the dynamic of these structures, in the money versus out of the money, I'm talking about true diagonals here, not a calendar. Okay. Horizontal, meaning using the same strikes. That's just iffy in itself, even though one's further out in time. But effectively what you've got here is sort of a stretched iron condor, more accurately a stretched short strangle position. In other words, just selling your 31 put and 33 call with nothing extra in it to collect a premium and have a wide upper to lower break even. Now, we're not expecting a large 10, 12, 20% movement on Intel. Just remember, it can always happen. But your lower break even's $29.51. So we're about $2.30 away from where we are now. Upper break even $34.61, just with this structure, of course. We could use other structures. But again, so that's about 3 points away. 10% movement on the position. It's less than 3 points, so it's less than 10%. Do you normally see that much movements with Intel, IBM, things of that nature? Not really. Do they happen? Yeah. Always makes me nervous to talk about an iron condor, short strangle, short straddle, double diagonal ahead of earnings, because the risk of a surprise. 9 times out of 10, you won't expect it. What if this is the 10th out of 10th time? That's why Ernie and I discussed we usually prefer to take a small portion of the portfolio. Sometimes I call it playing lottery tickets, buying a straddle or buying a strangle around earnings, even though I know I'm going to lose to the implied volatility crush and implied volatility decay. I'm not selling into it. I'm buying into it. I know that's part of it, but looking for a nice quick profit with a very small portion of the portfolio because it doesn't have a high chance of success. Could you go wider strikes to have a higher upper break even and lower break even? Vice versa. I'm sorry, lower break even, higher upper break even. Yes, you could play around with structure to target the probabilities you want. But this basic structure of being exposed to large mathematical risk compared to the maximum profit in either direction, one way or the other, if there is a massive surprise in the position, is something that's dangerous. Even with a stock like Intel, you know what can happen. If I did a similar double calendar structure as this, I probably want to maybe go a little bit further on the strikes, but as you can see, already selling this one, it's only 76 cents, and this one's 78 cents, around the same price. But if we went further to the 30 and say to the 34 or 35, even with earnings coming up, we might only be getting 40 cents, 35 cents a premium or so. I don't know if that's the good balance we're looking for, but it would give you better upper and lower break evens, but a much lower return monetarily and percentage-wise on the position. A follow-up question: what is your preference to in the money versus out of the money double diagonal? So I think I already answered that. And if you missed it, I'm sorry, but yes, this out of the money one, where we're buying a further out of the money put. No, I'm sorry, I highlighted the wrong one. Buying a further out of the money put to cover the near at the money obligation 7 days away, we're getting a credit here of 53 cents, okay, to do this position. But I have to factor in the monetary requirement. This is very similar. Again, as we showed with the call side, buying a 25 put and selling a 31, even though it's based on a calendar structure, this is akin to a bull put credit spread, where I have to cover the margin requirement because I have an obligation to buy shares of stock at 31. My coverage doesn't kick in until 25. My broker's going to want me to cover that in case the scenario where it falls below both strike prices, even if it isn't a calendar. Well, most brokers do. Some brokers don't require you to have the full monetary requirement if it's a calendar spread. It's calendar debit, definitely not. But calendar credit, typically they will if there's different strikes. But mine does, for example. Both of mine do, for example. But I know some others aren't, or they allow you to use some other differential there, looking at the structure of the position, okay? So I prefer to do it the other way, even though it costs more money. But once you factor in the $1,200 per contract you need for the margin requirement on both sides, the total monetary requirement, the maximum risk, and the monetary maximum profit are all about the same. That $1,200, $1,100 margin requirement minus the credit, or just straight debit was whatever it was, $1,196 or something like that for the other position, where I would have bought the 39 put and sold the 31, and bought the 25 call and sold the 33. I prefer to have the coverage in place where the put that I'm buying for the diagonal or call that I'm buying for a diagonal or a double diagonal is covering the obligation of the short, rather than, hey, I got a credit, that's really cool, but I still got to put up the margin requirement to do it. Because just we talked about in that previous discussion, which I apologize you might have missed too if you missed my first discussion on my preferred structure. If the stock's between the strike prices, as we discussed with that married put and selling a lower strike call, if they're both at the same expiration, in this scenario, you're not covered. You have to use some of that margin requirement to cover your obligation to, I'm sorry, this would be the obligation on the short call. My apologies, the 33 short call, because the insurance of the cheap call hasn't kicked in yet. So, the stock's at 36. You're either going to have to pay $3 to cover that, exercise your 39 call to cover that. And your broker might do that automatically, even though it's out of, that would be in the money. I'm sorry. No, the call would be out of the money. My apologies, folks. The call would be out of the money. My apologies. Your 39 call, 60 days out, would be out of the money. This one would be in the money. So if your broker doesn't exercise it automatically, you could be short shares of stock with the in the money long call, which they probably would exercise for you. But again, every broker is a little bit different if they're reading it as a calendar. So I prefer not to have the margin requirement up. And as far, again, as this discussion goes related to the double diagonal, you can see how it would work. You don't expect Intel to drop below 30. You don't expect it to move above 35 unless there's a sudden surprise. Who knows? There could be a sudden surprise. I don't know what they have up their sleeve. I haven't been following their earnings, so I don't know if they've got new products coming out, how well they've been doing. That's why we wait for the earnings report. But I've been following them in depth. You likely have food, so that might be something that you're more targeted, more akin to. And remember, I apologize, one other thing that's always got to point out on these, or short strangles, iron condors, it's known. But even in this, it gets a little, people seem to forget. The maximum profit is not in this range. I know you can see that, but some people look at the chart and they say, oh, I'm going to make this maximum profit as long as I'm here above 29.50 or 34.61. No, the maximum profit window, assuming another thing we have to talk about in just a moment, only occurs between 31 and 33. Beyond that, you're still making a profit, just not as much. Up until you hit that upper break even of 34.61, then the trade's starting to lose. Down here at 30, you're only making $50 of profit on the position. Okay, it's still a profit, but down here, now you're losing on the trade. Let's get a little bit more advanced without getting confused. I need to go to stock research real quick. When are our earnings? 4/27. Okay, so I did, didn't I? I did take a far enough out series. Yep, I took the April 28th. Okay. What do we know, and what does the market know about these options for the 28th expirations, and even the profit options for the June expiration. They're going to be affected by this earnings event coming up on the 27th, 13 days away, 1 day before our short obligation expirations. The profit and loss chart for any calendar spread, whether you're using power options, whether you're using your broker, is based on calculating the theoretical value of the farther out options at the short-term expiration date. Put it more simply, what it's doing is saying, hey, if the stock's trading at $32 on the 27th or 20, let's go to full 28th on that date, the expected values of the June options are calculated using the Black-Scholes pricing model. And in order to do that, it's using the current implied volatility of the long options if they're under 70 or so days out in time. Why is that relevant? Because after that earnings date on the 27th, depending on the move, if it's just a 1 or 2% move or a 1 to 3% move on the position, up or down, you're not going to see an increase in volatility. You're going to see a decrease because the event has now happened. Even if Intel moves down 4 or 5%, implied volatility of these options may adjust because the event has happened. That's going to work in your favor on the sold options. Well, let's take a look at this June 25 put and the June 39 call. But I think the June 39 call is going to be fine. Let's take a look at that one first. I want to go to research and I want to go to options research. It's got to load up the history. There it goes. So here we are here. All right, so this isn't too bad at all, but I have to anticipate it. We're only in the 18th percentile of the true implied volatility range for this put option, from 2959 to 0.5941. And right now we're at 0.35. Believe it or not, that is fairly significant. I'm going to give you 0.3. Let's take a look at our put. All right, so go to research, option research. Okay, not too bad, but that's also what I kind of expected. This one's close too. A range of 0.3445 at the low end, let's call it 0.35 to be nice, and 0.5269, excuse me, to the upside. We're currently at 0.464, so 64%, the total implied volatility range for this put option. Now, we're not at the peaks right now. It looks, oof, that's not the peak. The peak must have happened months and months, year. This has been out for a while. So the peak of implied volatility, might have been recently up here. Yeah, 0.48. That's not close, but it might have just jumped above that. It's been pulling down recently since then, but that's a pretty near high. And that's a closing, though. So maybe it happened intraday. In any case, if my stock's trading at, say, 32, in the range of my max profit zone, my implied volatility stay the same, expecting a profit of 135.50, close to the max 140.27 we saw. But after the event, Intel only moves its usual 1 or 2%. The event's now over. The unknown, known event, the unknown effect of the known event, I should say, is now over. What would happen if the IV of our long out to June call, this is the out of the money call, dropped to 0.30, back to its norm, to its lower level? And what if the long put option, currently at 0.464, dropped down to its lower level? I said we're going to give you 0.35. So this would be a value at 14. This would be a value at 13. You still keep all of the premium. What happens then? Okay, not too bad, but your options only go down to worth 3 cents and 6 cents with these out of the money options. Still a profit. You got to remember, you're not at max profit, even though you're the max profit level. Max profit really, there is a swoop here. You're right. There. Let me tighten this in. There's a swoop here where I'm looking at where it closes in on itself and is more skewed than an iron condor. the peak profit and loss is going to happen at one of the short option strike prices. We're just evaluating here at the middle at 32, sort of right where it is. But there is that swoop that you typically see there, the basin that comes in because of the calendar effect, the double calendar effect. Okay. But it's important to note, if you've got something that's really, really wild, where even the June options, or if you're trying to force a nearer term, let's say 1 month out, May bought series for your diagonals with the shorter term April 28th sale, or maybe May 3rd, May 4th, I forget what the first May expiration series is. May 5th. Okay, Cinco de Mayo. Those are probably going to be more affected by the implied volatility. So when you're testing your approach, evaluating your profit and loss scenarios of a double diagonal on power options or even on your broker, take a look at your current implied volatility range and what the high and low has been over the life of the option. Go back to your profit and loss chart and run that with the worst case scenarios of the buys, because in some instances, something that's more volatile by nature. Now, Lululemon, for example, had earnings, 2 or 3 weeks ago. I think it was up 30, 35 points from 280 up to 310, for example. It wasn't really highly volatile. But going into earnings, the shorter term or shorter breadth you use for your long options, implied volatility is going to be affected more. Your expected profit that you're seeing on the chart, the expected outcome and the maximum profit is based on the only thing we can do, the only thing your broker can do in calculating what is theoretically the long option going to be worth at short option expiration based on its current implied volatility. And you know what? If you have something wide, and one of those is pretty wide, actually, that wasn't too wide, but let's say we had a range of 0.295 on the low end for our option to 0.65. And the option currently has an implied volatility of 0.64, which you're paying into. Yeah, you're going to get a good decay and implied volatility crush in your favor on the shorts. But when you run that profit and loss chart, you've got to assume worst case scenario. Doesn't always happen to the worst case scenario, but you've got to assume, and you've got to be prepared for worst case scenario. The implied volatility on your long options drops from where you are currently at 0.64, which it would be using in the calculation, back down to that 0.29, 0.3 level now that the event has passed. And that could turn what you thought would be a winning trade into a small loss because the long options do not have the value you expect. Now, that's more, I'll be honest with you, that is more important in the structure that I was talking about, using the in-the-money options that offer the protection because I paid more into them. This credit one, we're using the out-of-the-money puts, but remember, you still have to put the monetary obligation for both sides in the position. For the put at 25 to 31, and the call buying the 39 and selling a closer 33. So you'd have to put up to $1,200 there in that scenario for one contract of each in this double diagonal. Or 600, I'm sorry, but 1,200 total. Now, in my scenario, I'd be buying, as I mentioned, the 39 in the money put and the 25 in the money call. Paying a higher premium. I'm paying a debit. So the value I get back to the profitable one, well, let's just put it in and we can show you. We use a similar example. I mean, by similar example, I mean similar IVs. We're going to use the same strikes we showed initially. 25 and 39. Buying the in the monies there. Okay, so now my debit's at 1296. Max profit, same, 141 versus, what was it, 140.57 for the credit one. Max risk still about the same. It goes 491 to 496. Same profit and loss chart. They're parity trades. Just I'm paying a debit where you got a credit up front and had to put up the margin. Good. Implied volatilities are about the same for the put and for the call. But let's say that we reverted back and the call dropped down to 0.30. I think is what we used on the out of the money call, and the put dropped down to 0.35. Oh, I'm sorry. This is okay. We'll do this. It's actually 31, 410, 424. I'm sorry. a few days before the earnings. Got to use 428. Okay, so I should have run, let's do that again. All right, so that's a profit of 121. Not too bad. Let's go back here. I got to resubmit this, my apologies. There we go. Now let's do the test level. 32 on the 28th after the earnings. Expect a profit of 135, near the max of 141. But again, you can see here, we've got our basin in the middle. It's right where we're putting it at 32. Max profit occurs at the upper or lower sold strike price. Okay. And again, I'm sorry for taking the buy options. Drop this down to 0.30. My June 25 in the money call. June 39 put, drop that down to 0.35. Instead of a 135 profit, if the stock's trading at 32 and 428, I'd set good. I did it right the first time. It's still 121. Not too terrible. But in something with a wider swing, say dropping from 0.64 down to 0.30, that could be a distinct reduction in expected value of your long options at the short option expiration date. It's something you have to pay attention to when trying to evaluate or construct or play double diagonals or double calendars for an earnings event, because you have to be aware of what's going to change. The implied volatility is going to change after the event. If Intel dropped 15 to 20%, sure, my implied volatilities are going to go up for my long call and my long put, right? That's too big of a move not to see implied volatilities increase. But if this goes down 10, 12, 15%, where am I? Well, $3 movement, $3.10 from where we are now, that's going to put us at $28.70. I'm in the loss zone. $3.34.89 and 10 cents, 99, right? So that's going to put us on the loss side up here as well. So now I'm having bigger issues to worry about than, the implied volatility of my call and put increase. That's great because of the movement. I'm going to get a higher extrinsic value for those options. Yeah, but you're in the loss zone for the entire position now. That's more important than seeing a gain there because of a large movement. That's not what you wanted. You want something very linear and stable. What do we think of just in general? Not getting too deep into this discussion, which we already have. I know, I apologize for that, but it's important to note. These are very important factors to consider when doing any diagonal spread, a standard diagonal calendar call spread or poor man's covered call. You want to evaluate what the expected return would be if there is a change in implied volatility, because that could change it to a loss or much less of a profit than you expected. Double diagonals, the same. You have to be aware whether you're using the out of the money call and put to buy or the in the money call and put to buy, which I mentioned I prefer because it's covered. I don't have to put up the extra margin. Scenario there is the same. Got to pay attention to the shift in implied volatility. Now we're talking about doing it in an earnings event where we know there's likely to be a drop in implied volatility. So I have to check that to make sure I'm still in the profit zone if I bought into too high of an extrinsic value or too high into an implied volatility. Now we talk about positions. You heard me mention an iron condor, the combination of a bull put and a bear call credit spread done on the same stock with the same expiration. Heard me mention a short strangle, just selling the slightly out of the money call and put on a security without having anything on the outside wings to limit the loss. You're naked a call and naked a put option. Short straddle, selling at the same strike for maximum profit. And then we can talk about a butterfly, an iron butterfly, all call butterfly, all put butterfly, so on and so forth. 1, 2, 3, these 5 structures. What is the most immediate thing that you think of when you see these 5 structures? Where is your profit level? Here, your max profit level. And okay, so to the upper and lower break even. Here on the iron condor. Here on the short strangle without having an obligation. This one singular point on the short straddle, which never happens. One of them is going to be in the money, so you're going to have to cover it one way or the other. And on an iron butterfly, same thing. There's sold call right at the money and sold put right at the money. One of those two is going to be in the money and have to be managed. It's never going to end right at the strike price. All right. Once in a blue moon, that might happen. But yeah, you still got an upper and lower break even, which might be pretty respectable in these scenarios. So you've got a wide range of profit. But your max profit is in a very tight window. The max profit you're using, say, oh, this could make 11%. And if I get that every 2 weeks, that's 284% annualized. If the stock always stays in this 3-4 point range. Okay, in this case, it's 5 points roughly. But again, what are we doing here? We're doing this as an earnings play into a known event with unknown outcomes. These are all neutral positions. By definition of the structure of the trade, they are all neutral sentiment positions. You don't want the stock to really move at all. Yeah, I get it. I see the benefit of it. I see the tease of it. I see the allure of it, and why people sort of teach this. Oh, you're selling into the earnings implied volatility. Don't buy into it, sell into it, get more premium. But you're selling into a neutral structure, going into an event with an unknown outcome. This is why I prefer not to do these structures for an earnings play. By definition, they're neutral. Earnings, as a definition, is an unknown gamble where the stock could swing wildly one direction or the other. You're taking the chance that you're going to see a high implied volatility decay in your favor for the sold options, which you likely will, without the stock moving. But the position has an increased implied volatility because the market expectation is there is going to be some movement at this event. Yes, I will agree with you, as I said at the beginning. Stocks like Intel, IBM, McDonald's, though I think they did decent with their last earnings, better than expected movement than they've seen historically. Not lighting the world on fire, but bigger movement than they've seen before, as expected. You know, average 2.5%, 3%, maybe I think it was 5 or 6%. Can't remember. Maybe I'm thinking of a different one. But yes, these are better positions than, say, trying to do this on an earnings event for a biotech stock. Maybe for Tesla, maybe for something that has high applied volatility, has wild swings. Stalwarts of the market, blue chips, may be a better play for these neutral positions, but you can see why I prefer not to use them, because I'm going directly, essentially, against the sentiment of the structure of these trades. The sentiment of the structure of these trades is neutral. You don't want the stock to move. I'm doing it as an earnings play where typically we expect to see movement. Will it be less than $2.40? Will it be less than $2.90? Maybe. Not expecting an 8, 9, 10% move. Could it? Absolutely. We're going into the known event with unknown outcomes in a neutral structure where we don't want the stock to move. That's why it's not my preference to do these types of strategies in earnings. Now, very simple follow up there. I said I'd do it earlier. Let's see, I search across our channel here, the YouTube, Power Options YouTube channel there. And there's a couple ones we could look at. I'm just going to type in earnings. Okay, let's go for that. Because there's a few you might want to take a look at, and I'll give you some of the names that I'm thinking of. First one year ago, risks of a double diagonal as an earnings play. Pretty much just covered that, but you can see another example here. 11 minutes and 15 seconds. I think this one's a bit longer. Best earnings strategies for earnings, protecting stock for earnings and more. So I don't want the video to start, but let me go ahead and take a look at this here. I want to read the description. What did I say about this one? Oops. Okay. What is the best strategy? We talk about earnings, long straddles at earnings, risk of selling premium at earnings play, and other strategies investors use around earnings. Best way to protect stocks. And something about the safest and most reliable option strategy. You know what my answer was for that. Okay, so that's another one. Strategies for earnings, protecting stocks for earnings, and more. Finding stocks with earnings tools. Are calendar or diagonal spreads a good trade around earnings? 18 minutes long, almost the same range, about a year ago. So I guess some other service was teaching this as an earnings play, and our attendees came to us to ask questions to get more details in that case. A little bit about straddles for earnings, so on and so forth. So those, I think, are the top three you might want to take a look at. Risks of a double diagonals and earnings play reinforces what we just talked about. Of course, this one will be posted as well. It's a year later. Why not? strategies for earnings, protecting a stock for earnings, and then are calendar or diagonal spreads a good trade around earnings? Another discussion from a year ago. And of course, we do have that full playlist of 8 videos for earnings discussion. I'm pretty sure all 3 of those are featured in that content as well. But it never hurts to review it, never hurts to go over it. I can probably guarantee you that some of the same discussion I just mentioned here, in this case, were discussed as well in this 11-minute video from a year ago. Concepts of being aware of the risk, being aware of the implied volatility shift and how that might affect your trade, as well as probably, I don't think I'd go into a comparison that we did here, which is good, of the out of the money double diagonal done in a credit versus the in the money double diagonal I prefer, where everything's covered. So that's what we have there for you. So just do search by earnings. When you go into power options, use that magnifying glass, do the search there for earnings. And we saw that these are the first ones that come up, but I think those 3 are the ones you want to focus on to reinforce what we just discussed today and gauge into a little bit more about earnings discussions and strategies for earnings. And this one, of course, will be up on Saturday afternoon sometime as well.